Welcome back. This is India Market Open. We're taking stock of the futures and options space. Well, it's been an eventful day. Yesterday, we have seen a substantial amount of short covering, at least in the Nifty futures, and the Bank Nifty futures are looking at, well, fresh longs. Let's take a look at how things have panned out yesterday. Now, starting off with the Nifty, we did see a sharp up move, and as far as the underlying goes, up around 3.4%, unwinding of nearly 11%, following the very, very volatile day of trade when the outcome of the elections came through. Bank Nifty, on the other hand, yesterday, and remember it was the weekly options expiry, that in fact advanced by as much as 4.5% with a 15.5% increase in open interest. And with that, we once again have the 50,000 mark in sight at the moment. Now, as far as the option market is concerned, the picture has been changing dramatically over the last 2 to 3 sessions, and perhaps on expected lines because the sharp moves on the respective indices. You know, coming down to the Nifty, naturally yesterday was a day where we saw the index advance, and which is why we saw a lot more writing in puts as against calls. But when it comes to your overall open interest distribution picture, at the moment we are still seeing a significantly higher amount in open interest as far as the 23,000 call is concerned. This is today's expiry. The question really is, can we hit the 23,000 mark today or no? It's a 2% move. It's not improbable, but well, it's a wait and watch on that one. And it's 2% after the kind of moves that we've seen over the past couple of sessions. Well, some traders may in fact want to bet on the fact that we can in fact move above that mark. On the other hand, there'll be plenty of others who may suggest that we've seen a significant move yesterday, and maybe it's a wait and watch on that one, but we can't rule out the expiry factor as well. So 23,000 will be a crucial factor, not necessarily saying that it is a resistance in today's day of trade, but it's something that a lot of traders will keep in mind. Moving on, let's talk about stocks. And again, it's a day where we have seen a lot of longs coming through. Metropolis, BPCL, REC, United Spirits, TVS Motor Company, all of them advancing in trade. Even in terms of stocks which saw unwinding in their respective open interest for the futures, well, they were all advancing yesterday. So, well, that would include something like a Navin Fluorine, Hindalco, City Union Bank. Hindalco, despite the fact that we had that update on Novelis where we're seeing, a liberal postponement, perhaps a shelving of plans for now at least, well, we did eventually land up with gains. So that's something to keep an eye on. But on that note, let's get in an expert opinion about what they make of these markets and how they're placing their bets. Well, we have Rahul Ghosh of Hedge.in who's joining us on the show. Rahul, good morning. Thank you so much for joining in. Very, very eventful past couple of days. Big, sharp moves coming in on either side, in either direction. But now that the dust seems to have settled or is still settling, what's the way forward from here?
Good morning, and thank you for having me. So last time we had discussed that the 23,000 short straddles had a lot of open positions by bigger hands. And that 23,000 mark, as you were also mentioning, seems to be an important point. And a true move on the upside can only be deciphered once that 23,000 level is conquered. So we might face some resistance around 23,000, and we might face some chopping around 23,000. That is a sideways move for some time around the 23,000 level. Also, till that level is crossed, that is till the 23,000 level is crossed, and there is a firm closing above it, we are not out of the woods with respect to the knee jerk that happened on 4th of June. So that's one very important point to keep in mind. Keeping that in mind is how we've planned today's option structure, where we are expecting, where the bias is on the upside, but we are expecting some sideways move around the 23,000 level. And also we need to be very careful that if in case markets give us some surprise and it turns back down, we don't lose much money. So the current strategy that I'm proposing today has a maximum risk of 1,000 rupees on the downside to make sure that even retail is able to participate and there's not much loss if things don't go away, but has a maximum profit of about 2,500, 3,000 rupees on the upside. If you're comfortable, I'll go ahead and explain the structure.
Please go ahead, Rahul.
All right. So what we are going to do is we're going to buy the 23,000 call of end June expiry. Firstly, all the legs of today's trade are going to be end June expiry. Normally, you've seen I've used multiple expiries, but owing to the current IV spikes and down move that is happening, it's better to play all expiries of the same 27. So we are buying the 23,000 call of the 27 June expiry. We are selling two lots of the 23,200 again of the 27 June expiry, and we are buying the 23,300 call again of the 27th June expiry. What this trade does is it makes you money if Nifty stays sideways or goes up. I repeat, if Nifty was to pass to 23,000 or 23,300 for that matter, this trade is going to make you money. However, if Nifty stays below 22,700 or 22,800, the maximum loss you can face is only about 1,000 rupees in the current structure.
All right. So here's how things pan out. Of course, based on Rao's strategy, if the Nifty actually does expire somewhere around 23,200, around the 27th of June, that is, towards the end. In fact, you actually do stand to make the most, and you stand to make the most in terms of your returns when it comes to this specific call butterfly that Rahul is proposing to deploy. On the other hand, as Rahul is saying, that what does happen is if the Nifty stays sideways or advances from here on, we are likely to make money eventually in this strategy. But if you do see the Nifty come off from here and perhaps trade at levels of around 22,700, 22,600 thereabout, then you don't stand to lose as much, and that perhaps is how this specific structure plays out. Now, that said, we also have a significant up move in a handful of FMCG stocks that have come through, and I believe one of these companies is on your radar today.
Yes, so Hindustan Unilever is something that has caught my eye for quite a while now. The stock has been significantly undervalued and still has a lot of potential for the upside. Having said that, I'm still being a little cautious because there was a sharp sell-off yesterday, unfortunately. So around 2,600 is where the current market price is. Above 2,650. I repeat, above 2,650, we initiate a simple bull call spread where we buy the 2,700 call and we sell the 2,740 call. I repeat, this should be done only above 2,650. The caveat of 2,650 is primarily owing to the sell-off that happened towards the end yesterday and where from the highs it sharply came off. But a simple bull call spread, once again, the risk would be very low, about 7 or 8 points only. And we have the entirety of June month for this to play out.
A tremendous run for a lot of FMCG companies, in fact, even through this phase of volatility. But Rahul, on that note, taking a moment to thank you for joining us and taking us through your views on the markets and, of course, giving us and helping us with a handful of option structures as well. Well, with that, it's back to you all.